all of the factors that people have been buying gold, the central banks buying gold to diversify out of the dollar in the face of dollar weaponization, I think at the minimum we can say that hasn't gone away under the current administration. They didn't start it, of course, but when you're threatening tariffs on the BRIC countries because, if you go against us, we're going to tariff you, that's all wildly bullish for gold. Is Brazil going to say, oh, we're so sorry, Mr. President, let's go buy some of your treasuries? No, they're going to say, let's dump your treasuries and buy as much gold as we can. So all of these factors, and then on top of that, you've got the changing economic thing that we talked about, which is going to get more people interested in gold. So any pullback would be a buying opportunity in my mind.
WisdomTree projects gold to reach $4,000 by 2030 in its base case forecast, pointing to the steady expansion of the global money supply and increasing demand for hard monetary assets. As economic uncertainty deepens, more investors are turning to stores of value that can preserve purchasing power amid ballooning debt, inflation risks, and declining confidence in traditional institutions. AdrianDay of AdrianDay Asset Management notes that if upcoming economic data comes in stronger than expected and interest rate cuts are delayed, it could temporarily ease the urgency behind the gold trade. Still, he emphasizes that the broader picture remains firmly bullish. Central banks continue to accumulate gold as part of a long-term shift away from the dollar, which is increasingly seen as a political liability rather than a neutral reserve asset. A recent World Gold Council survey of more than 70 central banks found that 95% expect to increase their gold holdings this year, while most anticipate a decline in dollar reserves over the next 5 years. If this pace continues, 2025 is on track to mark another record year for central bank gold accumulation. According to Day, this trend reflects rising concern among foreign institutions over the U.S. government's use of the dollar as a geopolitical tool. From tariffs to sanctions, the weaponization of the dollar has undermined trust, especially among emerging economies and key trading partners. That, combined with growing worries over the debt ceiling, fiscal irresponsibility, and questions surrounding the Federal Reserve's independence, continues to weigh heavily on the greenback. Even if gold experiences a near-term pullback over the next month or two, Day views it as a buying opportunity. He admits that feeling so confident about gold's long-term trajectory makes him slightly uneasy, but he believes the fundamentals strongly support the case for higher prices ahead. Gold touched a 3-week high on Monday, driven by safe haven demand after President Trump threatened new tariffs on both the European Union and Mexico. Meanwhile, silver also surged, nearing a 14-year peak and confirming the strength of investor interest across the precious metals sector. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
Obviously with any market at any given time, there's lots of factors, right? Some bullish, some bearish. And it's a matter of trying to weigh those different factors. Where we are right now, first of all, July and August have, for the last several years, for the last 15 years, they have been seasonally strong months for gold. So that would sort of maybe weigh against it. We've already had a pullback from 3,500 to 33. Okay, that would weigh against a further correction. But on the other hand, you could see a confluence of factors that are not completely out of a realm of possibility. I'm not talking about a balanced budget, but a confluence of factors in the near term that could cause gold to correct a little bit more. We really haven't had a proper correction in gold. The 3,500 was a bit of a spike. I know it did get there, it's real, but we really haven't had a proper pullback in gold for the last 3 years. If you get, what are they talking about? Is it 8 or is it 10 trade deals going to be announced very, very soon? Or was it 7 or was it 11 or was that yesterday or was that this morning? But anyway, they're talking about if you get a bunch of trade deals announced with important partners, like Japan and Korea, and the EU has said now that we're close to a deal. So if you get trade deals announced, if you get some more reasonably positive news on the economy, so that interest rates are not going to be cut again. If you get some more Arab countries, particularly say Saudi Arabia, decide to join the Abraham Accords, they've been there's a lot of talk about that right now. I think that's a confluence of factors that could see a little bit of a steam taken out of demand for gold and cause a bit of a pullback. If we see that, over the next, say, 6 weeks, month or 6 weeks, I would see that as an incredible buying opportunity. And it may not even happen, but if you look out 6 months a year, it's difficult for me to be more bullish than I am, and that itself is a dangerous thing, I realize. But all of the factors that people have been buying gold, the central banks buying gold to diversify out of the dollar in the face of dollar weaponization, I think at the minimum we can say that hasn't gone away under the current administration. They didn't start it, of course, but when you're threatening tariffs on the BRIC countries because, if you go against us, we're going to tariff you, that's all wildly bullish for gold. Is Brazil going to say, oh, we're so sorry, Mr. President, let's go buy some of your treasuries? No, they're going to say, let's dump your treasuries and buy as much gold as we can. So all of these factors, and then on top of that, you've got the changing economic thing that we talked about, which is going to get more people interested in gold. So any pullback would be a buying opportunity in my mind.
For gold and the gold stocks, I imagine.
Gold stocks as well, yeah. The gold stocks will really take off. I mean, we're already beginning to see it. I mean, the gold stocks have done well, and it's incredible. But when you see the XAU or the GDX up, 55% or whatever in the last year, and that's in the face of outflows from the GDX, from the GDXJ, that's pretty astonishing. So can you imagine what's going to happen when ordinary investors, and by ordinary, I don't mean just small investors. I mean ordinary investors, that's including money managers, registered investment advisors, and so on, start to buy gold. And we're just beginning to see that. The fact that silver's outperformed gold this year, the fact that the GDXJ has outperformed the GDX, even though the J isn't really juniors, but nonetheless, the somewhat smaller stocks are outperforming the bigger stocks. These are all signs of interest from what I'll call ordinary investors, from retail investors. My sense is that we found a new floor, and the new floor is definitely, well, I say definitely, but the new floor is a 30, and, perhaps even a 33. So, we've broken out, and I think we've got a new floor at a meaningfully higher number than we were before, perhaps even 33. But I'm not sure we're going to see silver shoot to $50 or $100, anytime soon on this move. I've had people ask me on silver, is this it? I'm not sure what it is, but no, I don't think this is it. The thing about silver, you've got, obviously we know this, you've got the industrial demand, and then on the supply side, you've got the fact that you've got two things that are grossly different or vastly different from gold. First of all, you've got most silver supply is byproduct, so about 75% of silver supply is byproduct, and it's byproduct not of gold, but it's byproduct of zinc and lead. And so I've said this before, the lead miner in Bolivia does not build a new lead mine with 10% silver byproduct just because the price of silver went up, right? And so silver supply does not respond well to changes in the price of silver, which is one of the reasons that the silver price is so volatile. That works on the downside as well as the upside. You don't close your zinc mine because the price of silver went down. The second major difference is there are no stockpiles of silver, no meaningful stockpiles of silver. And so if you get a big run suddenly, there's no big supply to suddenly come on and take that away. And that's another reason why silver moves can be so dramatic. So the setup for silver is certainly very, very good. But in order to get that move, you really need to start getting retail investors come in droves, because when they come in buying silver in droves, and you get inflows into the SIL and so on, the PHYS, spot physical silver. When you start to get inflows into those ETFs and people buying silver coins at the coin dealer, there's nothing to stop it at that point until it just gets crazy and people who bought at 40 decide to sell at 60 or whatever. And we're not there yet. There are not indications, talking to my friends in the coin dealing business, looking at the flows into the ETFs, there are not indications. There's a shift, but there's not a flood of money pouring in. As you said, people are cautiously optimistic. And so for these reasons, I don't think this is it, whatever it is. But I do think we've got a new floor. And so at some point, we'll see those kind of flows come in, and then silver will move dramatically.
AdrianDay notes that gold's continued ascent is now capturing broader attention. Initially, many dismissed the rally as a short-term move, but as prices have steadily climbed, The market is starting to take it seriously. That growing recognition alone is fueling more interest from both institutional and retail investors. This week, traders are closely watching upcoming U.S. economic data, notably the Consumer Price Index and Producer Price Index, for signals on the Federal Reserve's next move. Market expectations currently point to 50 basis points of rate cuts before year-end, likely beginning in October. A declining interest rate environment has historically been favorable for gold, which carries no yield and becomes more attractive when real rates fall. Meanwhile, analysts remain upbeat on major gold producers like Newmont. The stock holds a consensus buy rating, with the average price target at $94.41, implying a potential upside of 16% from current levels, according to Refinitiv. Long-term technical indicators show Newmont in a clear uptrend, although there's some short-term selling pressure, as noted by ASX TradeWatch data. Day highlights that gold miners are increasingly standing out to serious investors. Margins are expanding, and free cash flow remains strong across the board. Remarkably, the sector has now logged 6 consecutive quarters of rising cash flow, an uncommon feat in the often volatile mining industry. That consistency is beginning to attract more investor attention, reinforcing the broader bullish case for both gold and gold-related equities. Let's get back to the interview.
We did have, a few months ago, we did have a bit of a pause from several, or slowdown in the buying from several of the central banks. But central banks are still far and away the largest driver. But of course, it's all what happens at the margin. If they used to buy X and now they buy X minus 10, that matters. But the central banks are still buying. China, as you know, in the latest numbers that came out yesterday, China's still buying. That's the 8th month in a row that they've been buying, because they paused last fall. So they're still the main buyer. Where we've seen a bit of a change recently, or the biggest change recently, is with the non-official Chinese sector. That buying, which shot up in the spring, has subsided. Early spring has subsided. I don't know that that's permanent. It's probably coming back. But the next move, it seems to me, is with North American investors, not the Ray Dalios and Bill Druckenmullers and so on, but ordinary, not just retail investors, but investors, family offices, small institutions, investment advisors telling their clients, money managers, etc., all of that. So I think the next leg is going to be the North American investors who've really been out of this market, as you know. I think the first thing that's causing people to look is simply the fact that gold has moved up so much for so long. And so, when it started to move up, people didn't really notice. And then you sort of notice, but say, oh, it's only temporary. But I think now it's clearly a thing, but you have to look at. So that's obviously the one thing. The miners are obviously doing incredibly well for investors, for serious investors. The miners are doing well, and they can see the growth in the cash flow, growth in the margin, that is leading to growth in the cash flow. And it's, for a lot of companies, there's free cash flow, which is, an unusual thing for gold mining companies. So people are beginning to see that. And again, that was not just 1 quarter or 2 quarters. That's now been 6 quarters of increasing cash flow on very, very strong margins. So that's getting attention. But I think what's going to drive it looking forward, okay, step back. Remember, a typical North American investor buys gold, and by gold I'm now talking about gold assets, generally, when the economic environment is right, when the economy's slowing, because you think that means the Fed will start cutting rates, when inflation is high and increasing, when rates are low and being cut, and when the dollar's falling. That's the perfect economic environment to be looking at gold. And that's the precise opposite of what we've had for the past several years. So it's no surprise to me, it's not illogical, let's say, it's not illogical that most North American investors have not been looking at gold because the economic environment has just not been conducive to it. But as I see it, all that's beginning to change. The dollar's obviously down a lot this year. It's oversold, and it's significantly oversold on the short term, in my view, but that's a different subject. But the point is the dollar's been falling after being consistently strong. Inflation is sort of, it's not under control, and Jerome Powell, the Fed chairman himself, is concerned. So if he's concerned, shouldn't we be concerned? There's more indications that the economy is slowing, both the consumer, spending, if you look at the patterns of consumer spending, are they spending on necessities or is there a lot of consumer discretionary spending? There's no consumer discretionary spending. And so that's a bad sign. And of course, the jobs market is nowhere near as strong. If you look under the hood, under the bonnet, it's nowhere near as strong as the headlines would suggest. And you only have to look at the revisions to see that that's true. So clearly the economy is slowing, and so all of the economic factors are now beginning to move in various degrees in gold's favor. And the only thing holding up at the moment, of course, is the S&P in the stock market. And but you're seeing the Magnificent Seven are all starting to roll over, or most of them are, and so that's making people look for other places to put their money. I'm not looking for a market crash anytime soon. One never knows, but that's not my base case. We're already seeing the market breadth is bad, but it's not as bad as it was at the end of the year. So we're already seeing that there is some dispersion and there are some stocks doing well in the S&P other than the Magnificent Seven. It's not as bad as it was. We're already seeing some money flowing into European stock markets. Europe, of course, but the European markets have outperformed the US this year. That's the first time in many, many, many years. So and that's because of the flows. We're seeing flows from US into Europe, but we're also seeing a lot of the steady flows from Europe into the US market are slowing. And I think that's a major theme, frankly, going forward, that a lot of the money from abroad that would typically just flow regularly into the U.S. stock market, I think we're going to see that slow dramatically and even reverse in the face of a lower dollar, in the face of tariffs, in the face of the general, I don't want to say hostility, but the general government attitude towards foreign investment. So I think we're going to see that reverse.
Momentum is shifting not just in price charts, but in global sentiment. As trust in fiat structures continues to erode, gold's quiet reemergence as a cornerstone of institutional portfolios signals more than a market trend. It reflects a more profound realignment in financial philosophy. Meanwhile, mining equities, once overlooked, are drawing attention for their resilient fundamentals and consistent performance. The backdrop is clear. Confidence in traditional levers of monetary policy is waning, and the search for real, enduring value is intensifying. Will the growing disillusionment with central bank credibility and fiat dominance permanently reshape how nations and investors define haven? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.